Okay, so let's take it from the top. What is a venture capital fund? So what is a fund? A fund, just like a mutual fund or an exchange traded fund or a hedge fund, is essentially a pool of capital that is used by a manager to invest on behalf of investors who put money into the fund. So it's like imagine like a bucket of cash that the manager distributes into different assets. And for VCs, it's a little bit different than other types of fund managers. So a venture capitalist is a fund manager, and what they invest in is early stage tech companies predominantly. Another thing that makes VCs fundamentally different than other fund managers is the fact that venture capitalists get actively involved in the companies within their portfolio. So unlike a mutual fund manager who might invest in Tesla or Apple or Rogers, a VC doesn't just try to pick undervalued companies and hope that the share price increases. The VC is more of a growth investor that sits along with the entrepreneur and acts like the entrepreneur's partner in terms of identifying opportunities to grow the company with you. So it's very much kind of a partnership. It's not just a passive investment. And that's an important thing to realize, again, when you're pitching a venture capitalist, because they are going to be working with you. They need to see that they can add value in your business. And when any investment is made within the world of finance, there's always a trade-off between what we call the two pillars of the investing world. Does anyone know what those two pillars are? They each start with the letter R.
Risk and reward.
That's right, risk and reward, or risk and return. That's exactly right. And then when an investor is selecting an asset to deploy capital into, they're always balancing those two things. They're looking at an investment opportunity and they're saying, okay, this investment opportunity has a certain level of risk. And in order for me to take on that level of risk, I need to be compensated with a sizable amount of return. So for example, if you're pitching an early stage tech company, and that early stage tech company, because it doesn't have a long track record and you're a first time entrepreneur and you're inventing a product that maybe you haven't developed yet, that inherently has a high level